John Rutledge, Chief Investment Strategist at Safanad, joins us from Irvine, California. Dr. Rutledge was one of the principal architects of the turnaround for America during the first term of Ronald Wilson Reagan in 1980-81, and also an advisor to George W. Bush 43's White House on tax policy, and once again joins us from the great Golden State. Dr. Rutledge, thank you very much for joining us. I guess the Fed did what they were going to. I guess the Fed did what they're going to do, right? Kind of string it along, kind of take a view down the road. That can probably is flattened right now. The one they've been kicking for so long.
You know what they did today is another open mouth operation. That seems to be what this Fed likes to do. And I think that, yeah, they're not going to do anything material until after the debt talks again, so probably February, March of next year. But this quantitative easing, Bob Heller's right. It's like a gigantic time bomb in the desk of the next Fed chairman.
What are we going to see in the next day, weeks, and months to come? Because the confirmation hearing will come up. There will be some hard questions lobbed at Dr. Yellen from the GOP, especially those who don't like who like to go dove hunting. Is that going to be a turning point? Is that going to be a defining point in terms of maybe not mouthing off so much with open mouth operations and having to bear down and actually maybe pin down a date on the calendar?
Well, the truth is, Bernanke is actually the inventor of this policy of trying to explain to people what's going on. So when he leaves, some of that should go with him. But Yellen is to the left of Bernanke. Yellen's going to be less eager to tighten than Bernanke. And so once she gets in the chair and we're past the debt talks again, you're looking at a Fed that wants very much to see more growth, less employment. So in the coming weeks, I think you're going to see the economy's kind of flat right now. But there's an enormous pile of reserves that the Fed has printed. So the stock market looks okay, but the real economy and jobs don't.
So that's just the crux of it, Dr. Rutledge. I mean, if the economy is just kind of bumping along with no spike in sight and no real epiphanies on the, in the scope right now, and the stock market, we have hit high after high. Today we took a little bit of a step backwards. Maybe it's the Halloween parties and all that. But I mean, can we keep going like this? Can we keep going on two pathways? It's almost like you've got Amtrak on one and the interstate on the other. You can call the government one and the economy one, and you call the market the other. But they don't seem to be meeting at any point. There's no junction.
That's right. They're going two different directions. The real economy is going along with 150,000 jobs a month, not enough to really grow. But the financial economy has been affected by the QEs we've had all in a row. There's now 400% increase in the monetary base, and bank reserves are up 17 times since before the financial crisis. That money is not being loaned fully by the banks yet because the banks are still stuck. But the banks are beginning to loan it out. And when they loan it out, it turns into loans, deposits, money supplies, and then spending, and finally prices. So there's a huge inflation story down the road. In the meantime, of course, it hits stock prices. I'm fully invested because of that 400% increase in the monetary base, not because of real GDP.
But those which you call interest rate sensitives, I mean the housing, the builders, the Toll Brothers, the KBs, the Pulte's of the world, Home Depot, DIY, I mean anything that gets negatively impacted when rates start to rise, and small basis point rises can actually affect your mortgage serviceability quite dramatically. Those are probably no-go zones right now. You'd veer elsewhere into the markets.
Yeah, I'd stay away from those, and the lesson there is what happened last spring when Ben Bernanke started talking about the taper, when the rates moved up 100 basis points in just a few weeks on the 10-year bond. And so you don't want to be anywhere near interest rates or interest-sensitive stocks right now, and bonds are more risky than stocks today by a lot. Where would I like to be? I'd like to be in the parts of the economy where the liquidity creates a gush of buying, and that means, first of all, the equity market overall. Second of all, the private equity side of the equity market. So if I had to pick some stocks, Blackstone, Oaktree, Apollo kinds of names that do leverage buyouts and junk financing. Third, small cap stocks do better because during the credit crunch, small companies were denied bank loans and had to go outside for expensive money. Now with the banks coming back to life, the cost of capital for small companies is falling very sharply. So small caps is a good place to be. And stay away from emerging markets. When the U.S. rates go up, capital flows out of emerging markets like we saw early this summer, and that's a very dangerous place to be.
Dr. Rutledge, I can hear this collective groan that you just led people over here in the Pacific Rim to utter out on the back of those words, but great having you here. We'll have you on again. Dr. Rutledge out of Irvine,
Great to be with
California.
you.